Good morning, everybody. Very happy to be with you again. In this section, we will walk you through the project maturity, relevant cost, and cost efficiency criteria. We will update you on the differences compared to the first stage and on the new elements that we are providing for you to enable you to submit good proposals, good submissions in the second stage. Next slide, please. So, going directly to project maturity, as in the first stage, we have three sub-criteria: technical maturity, financial maturity, and operational maturity. This is, I guess, very familiar with all of you. Obviously, the difference in the second stage that we are very much looking to details. And in the second stage, this is it. This is your real presentation. This is what will or will not convince the evaluators. We have reflected upon feedback received from applicants so far. Therefore, I hope we have improved the documentation. We have improved the logic flow of the application form, and we have provided table of contents for the accompanying documents. So what you will see in your feasibility study template, we have provided the table of contents, which we are asking you to follow. This also allows the evaluators to have a more consistent and standardized evaluation. Compared to the first stage, please always highlight and explain very clearly any changes in your project submission compared to the first stage. And Robert will later on explain which changes are permissible, but be very precise on this. In the technical maturity, we will be looking whether your project can or cannot deliver the output as expected and whether you can avoid the greenhouse gas emissions as planned and expected. And you will see in the application form that we have slightly readjusted the questions, but please follow them very thoroughly and be as precise as possible. Again, also in your submission form, in application form, highlight and explain any changes that are different to the first stage. In the second stage, we are very much interested in looking into evidence. More evidence you can provide, more credible your presentation is. So please take due account of be consistent, be convincing, and provide as much evidence as you can. And again, for the technical maturity, if you have technical due diligence report, please attach it to your application. Compared to the first stage, here in the second stage, we will also very much focus on risks, much deeper than in the first stage. So therefore, in the application form, you will see in section 4.4 the risk matrix, which we ask you to fill in. Focus there on the key technical risks and be very credible on how you are going to mitigate them. Be realistic, but be convincing with your mitigation measures. As regards the feasibility study, you will see in the new table of contents that we are asking you to be very detailed on the risk analysis there. So provide also the risk heat map in your feasibility study and provide as many information, as many details as you can in your feasibility study, while in the application form, in the risk matrix, focus on the key risks and key mitigation measures. Again, very important message here is the consistency of the presentation. Your presentation needs to be coherent, whether it is the application form or whether it is related to your accompanying documents. Next slide, please. In the operational maturity, the same messages as for the technical one. We have provided the table of contents for the project implementation plan to allow more consistent and standardized evaluation. Again, there, don't forget to highlight and explain any changes compared to the first stage. In the operational maturity, we will be looking into how credible your plan to implement the project is, whether it is sufficiently developed, whether it is comprehensive, whether it is realistic. So be very precise and think well through all your implementation steps. Be as detailed as you can. And again, underpin your claims with evidence. If you have a due diligence report, again, attach it to your application. And also in the terms of operational maturity, the project implementation planning, the project implementation steps, be very precise on the key risks related to the implementation of your project, whether this relates to permits, whether this relates to any other elements that may delay or endanger your implementation, and provide very clear and consistent mitigation measures in your project implementation plan, which need to be reflected in the risk matrix in the application form in section 4.4. Next slide. Okay, financial maturity. I think this is one of the cracking sub-criteria for the second stage. Here we have, again, slightly adjusted the application form, but we have also some novelties in the second stage. In particular, the financial model summary sheet, which is a mandatory document that you need to fill in and submit. This has been provided for you in order to be able to provide consistent information. So if you calculate your relevant costs following the template on the portal, you should also provide the inputs in the financial model that need to be coherent and consistent. And Gregor will walk you through the details of this in a couple of minutes. Going back to the business plan, again here, please don't forget to explain and highlight any changes compared to the first stage. The project may have evolved, the market may have evolved, the regulatory elements may have evolved, so please be precise there. We will look into financial maturity sub-criteria, whether your project is financially ready to reach financial close and whether it is likely to succeed on the market. Therefore, it's very important that your claims are consistent, that your messages in the application form, in your accompanying documents are consistent. For instance, if you are planning and providing your calculations, if you plot your cash flows, your revenues, they need to be underpinned and consistent with the evidence. Like if you calculate your revenues, please provide evidence that this is based on your potential future offtake contracts. Please provide the terms of those contracts. The same goes to your CAPEX. Please provide any evidence related to your suppliers, to the terms of those supply contracts, because they will be important for calculating your costs. And all these need to be very clear, very consistent, and very convincing. What is also important, and this is a reply to many of the questions that we received, at which level these supporting documents should be. Well, this is the second stage. So this is the time once the project gets accepted and you will sign the grant agreement, you will go off to the market. So that's why any supporting documents like letters of support, like memorandum of understanding, terms of agreement, they also need to be signed at appropriate level, whether this is the CEO level or a board level, so that the evaluators are convinced that this is real, this is happening, this is convincing. Again, as with other project maturity sub-criteria, we will have a very deep look into your risk analysis. Therefore, in the business plan, if you follow the template, you will see there is a part addressing the risks. Be very precise and very, very detailed, very comprehensive. And then reflect your major financial risks also in the matrix in section 4.4 of the application form. This is very important in the second stage, that whenever there are issues, those issues are addressed, those issues are well thought through, and you have contingency measures in place to address them in time to ensure that the project is implemented and funded. Next slide, please. Okay, this is a bit more about financial maturity. And again, Gregor will complement this with very detailed and precise information about the financial model, and he will recall also the key issues related to calculation of relevant costs. So we are looking to how credible your business plan is, how well you understand your market, what is the value of the innovation for the project, for the company, what is the competitive position of your project on the market going forward, Important, as I mentioned, is that any financial projections and calculations are realistic, credible, and underpinned with evidence, so that also the evaluators can believe that the numbers are based on credible assumptions. Also focus your presentation on the financial viability with the Innovation Fund grant, whether this is related to internal rate of return. Here, what is important, if your project has a lower internal rate of return, it has to be clear that despite this, the project funders and financiers are keen to go ahead. And you have contingency measures if anything happens to ensure that the project is going ahead. As I said, we have included the financial model summary sheet as the way to present consistently and in comprehensive manner your financials that are also the input to the calculation of relevant costs. This is the minimum requirement, but you may also submit your full financial model if you like. And this should be the financial model of your company for the project. We will be looking to the soundness of your financing plan. So how well are your financing sources covered? So not only identified, but essentially covered to ensure that the project can really be signed off and you will reach financial close. How well have you thought through the steps to reach the financial close? And what is the support and commitment of your shareholders, of your partners to finance and implement the project? And as regards the financial risks, again, we have seen many good presentations in the first stage, but really be as detailed as you can and as critical as you can. Try to find ways to address the key risks, whether they are related to your viability, coming from the difference in the costs or revenues. What happens if the costs or revenues change? How can you mitigate that? Or whether this relates to your financing plan. So what happens if any of the funders steps off the project? How would you address the gap there, and how would you ensure that the project goes ahead? So these are, I would say, the key messages related to the second stage. As I said, similar to the first stage, but much more detailed, much more similar to what any other investor do when they are doing the due diligence assessment of your investment. I hope we have provided the framework for a very good presentation of your projects. So follow very closely the questions in the application form, follow the templates that have been prepared, and be as precise, as credible, as much underpinning evidence as you can. I would stop here and pass the floor to Gregor, who will now walk you through the key elements related to the relevant cost calculation and especially the financial model and the cost efficiency calculation. Thank you.
Good morning, everybody. So regarding the updates that have been made to the relevant cost methodology, this is a methodology that you all are familiar with. In order to help answer some of the questions that we've received during the process of interacting with you in the first stages and answering some of the questions that were posted, we've tried to provide greater clarity regarding a variety of components of the financial model and relevant cost calculation. And so new terms have been better defined in the glossary now. So as far as CapEx is concerned, construction costs, the site infrastructure, development costs, and importantly, intangible assets. There were a lot of questions around, can certain costs of developing IP be included in the project? And we've been quite specific now in determining what costs can be included in CapEx as regards intangible assets. It's important to note that this is not intended to fund development of ongoing IP that's going to be used in other projects. It has to be done very specifically related to the necessary CapEx at a market-related arm's length price as far as intangible assets are concerned. And it can't result in any leakage in the project at all. As far as revenues are concerned, all revenues generated by the project and operational benefits and external benefits, of course, excluded. Those have been defined more deeply now in the latest set of guidance. And specifically, as far as any feed-in tariffs are concerned, those are now to be taken off the OPEX in the calculation of the relevant costs. And a good example here would be a feed-in tariff, which is an operational amount which is given to a project in the member state to promote the project or to let it get closer to financing. SDE++ is probably a good example in the Netherlands of this type of regulatory support program. And the purpose here is so that we don't have any double counting of funding or double funding of a project where two sources of concessional financing are doubled up for the benefit of an applicant. Next slide, please. So the key principles for the relevant costs in the legislation, in the regulation, are that these are additional costs borne by the applicants, and they are as a result of the application of the innovative technology. So it's expected that the innovative technology, of course, will be more expensive, but this must be related to the reduction in emissions, so the application of the technology, obviously, to meet the emission reduction. And I'll come back to this because this is an important point and how the cost efficiency calculation is done. So for most of the projects, and we'll get to the exceptions here, you should be using the levelized cost of producing an output unit with the new technology against whatever the market price is or the reference price. Now, this is the standard default methodology which should be used, and there are exceptions to this. There are fallback options, which are, of course, to use the old reference plant methodology. And in exceptional circumstances where there's no reference scenario at all, there's no market price, you can use the no reference scenario, but this is unlikely to be the case with most projects. Next slide, please. I'm still not sure if I can ask the operator to make my video active. I'm unable to do that, but again, I'll continue. If someone can try and make my video active, that would be great. We've produced a decision tree. This has been mildly updated just to provide further clarity, but effectively it's the same as you've seen previously. The first step is to determine which of the scenarios you should be using. Which methodology is applicable. And the first one is, first of all, is there comparative conventional production? If there's no comparative conventional production, you look at whether the production involves electricity storage, which is a specific case, which has its separate methodology. And if the case is no, then of course the reference scenario can be ignored and you use the no reference scenario methodology. If the case is that electricity storage is involved, of course, you use that levelized cost of storage methodology. Then going back to, is there conventional production? If there's a reference price for the product in the market, if it is replacing a product which has a market price, or indeed it has a market price for what's being produced in a different way, then you can use the reference price benchmark. If there is no reference price whatsoever, you ask the question, is there a product with a model reference plant? In other words, is this the benchmark plant for this type? Can you compare it for conventional production to that of your plant? And then, of course, you've got to ask, are the data available to support that? And if that is the case, then the reference plant methodology would be used. If there are no data available, one has to use the guidance to complete the financial template to meet the data requirements for selecting the reference plant methodology. However, again, just to emphasize that the default technology will be the levelized cost methodology, where you're comparing a unitized cost per unit against a reference market price. Next slide. So the levelized cost is a cost of 1 unit of production over the full lifetime of a project. And it does that by including the financing costs in the total cost of operating and financing the plant. So it provides a flat, single, non-escalating unit cost of production over the lifetime. And this is the methodology that's predominantly used to see how electricity prices for renewables have been reducing over time in the market. But we have adapted this to the model that we're using for calculation of relevant costs. There are slightly different variants of this methodology. The first one is calculating the electricity generation levelized cost of energy, or levelized cost of electricity, which is the cost of producing a megawatt hour of energy. The product manufacturer one we call levelized cost of product, and this is a unit cost for whatever your unit of production is, whatever the single product costs, against a reference price. And then for the storage, using the cost of discharge of a megawatt hour of energy. Next slide, please. So the reference plant methodology then, the existence of a reference plant is important. It has to be the benchmark installation as defined by the ETS regulations on a benchmark installation in the case of industrial products or fossil fuel equivalent for renewable energy or heat in the case of those. And the most important thing in order to use this methodology, if, of course, there isn't a reference product or price available, and this is the default, this is the fallback position, that this cost data is available. In the absence of this cost data being available, this methodology, of course, can't be used. And the project capex revenues and the operational benefits are then compared based on the best estimates of the same parameters for the relevant plant using the conventional technology compared with the product and location of the plant in the case of the applicant's project. Next slide. So the no reference plant methodology, this is a last resort methodology. It's not, as I said, expected to be very common, and it's only to be used in situations where there's absolutely no comparable reference plant existing, either in the EU or globally, and that no reference product exists. Here, you're simply providing the relevant costs based on the actual project cost data, and the revenues and operational benefits and OPEX, and then calculating the relevant cost on that basis. Next slide, please. So the key principles for relevant costs in terms of the rules for calculation is we've included some clarification of prices. Now, these assumptions are based on an average price as far as carbon price and allowance assumptions are concerned, which obviously are calculated as a benefit in the case of industrial projects, which have the benefit of receiving allowances for reduction of emissions. And these are based on the average price of 2019 and 2020, which has been approximately 24.81 euros per tonne. And the indexation and inflation assumptions, we had a couple of questions this morning on this. The average indexation of the prices to be used are those of the 2019 and 2020. You will see this in table 4.2, I think it is, in Annex B of the guidance. Now, it's important in our calculation that project finance norms are adhered to in terms of terminal value. So there is the assumption on all of these calculations that there is no terminal value to be associated. So in the calculation of relevant costs, for example, you wouldn't take off the value of received from a terminal amount. And in the reference plant methodology, similarly, there's no terminal value. It is simply just for the time that the costs are being calculated, that those OPEX and CAPEX costs are included. There is also no ability within the calculation methodology to claim any write-down or cost of not being able to use technology which has already been funded. So a write-down of an existing technology, losses made on replacement of existing technology because those costs were incurred previously and that hasn't been fully depreciated, that is not allowed in the methodology. Next slide. So what is the levelized cost of methodology? All of you know this, I think, by now. Let's take the LCOE example. This is option 1A. And this applies to electricity or energy production projects. Here, the principles are that you apply the levelized cost methodology to determine a unit cost of your production in your new project. And this basically includes the financing costs by assuming a weighted average cost of capital discounting factor. So what it does then is it calculates a levelized cost by taking the investment cost, the CAPEX, adding the O&M cost and whatever fuel cost, if there is a fuel cost, in some cases there's not. And for both of those, discounting those future cash flows, negative cash flows, against the weighted average cost of capital, which is the combination of the debt and the equity cost of financing. And then this is divided by the amount of units of energy produced, also discounted. And that's discounted to take account of the financing cost, and therefore the total in the calculation with a higher discount rate producing a smaller amount of discounted electricity unit will result in a higher levelized cost. This then is compared against a reference price, which is a price which is currently achievable in the market price. And the difference between these two calculations, of course, or two prices or costs, is that the levelized cost is a levelized non-escalating cost, a unit cost over the lifetime of a project, where the reference price is a price at a point in time in history which will be escalating over time. So again, you look at the difference between these two prices and then you multiply that by the discounted number of units over the period of time that the project is operating for, and you get to a relevant cost. Next slide, please. Now, there is one adjustment. Because the regulation states that CAPEX and OPEX and operational benefits over the first 10 years of the project need to be taken into account. And when you calculate a levelized cost over the lifetime of a project, you're including the OPEX, which is post 10 years. So if it's a 20-year project, you're including OPEX, which is included in years 11 to 20. One has to make a slight adjustment to this calculation to take into account of the fact that you shouldn't be, by regulation, actually including those OPEX costs. So the adjustment is made to the calculation by removing that portion which contributes to the levelized unit cost, which is represented by those discounted costs which occur after year 10. And so it's important that this calculation is correct, and the applicant should verify the effect of the NPV on the difference between the OPEX of the project and the conventional technology for the remaining life after 10 years of operation. Now, as with all of these calculations, they're done for simplicity purposes, and the calculations are done to allow a comparable methodology across a number of very different projects. So if we were to provide absolute 100% accuracy in a methodology, it would become inordinately complex. So, of course, there are some minor inaccuracies where projects in a conventional technology might have an enormous amount of operational costs as opposed to CAPEX, and the new technology might have a very high CAPEX but almost no operational costs. So in the case that the applicant believes that this will be the case, there is the possibility of providing evidence for that, but that must be a highly detailed calculation in order to be justified to move away from the standardized methodology. And the standardized methodology is there to have a unified, comparable calculation across a number of projects. So if there's any diversion from that, just for this adjustment, then that has to be very, very well justified. That being said, because this is based on discounted costs at the very end of the project and it's only operational costs, it generally doesn't have a very material effect. So it's just a point to be made that can be done, but again, it's probably not going to be material in the calculation. Next slide, please. So the levelized cost methodology of product, very, very similar. You're calculating a unitized, non-escalating unit cost. You're comparing it to a reference price in the market, and the calculations are based on exactly the same calculation formula where you are using your weighted average cost to capital to discount the O&M and the ongoing variable costs, and those are then also divided by the discounted number of units produced over a period of time. Next slide, please. So let's look at a hypothetical project example. We need to calculate the discounted cost per unit of production using the LCOP methodology. So the first step is to establish what is the CapEx and OPEX of the project, and we need to know what is the upfront cost of construction, what are the fixed and variable OPEX components for the project lifetime, and what are the number of units we are going to be producing, whatever that unit is, whatever that product is. We check the indexation, which is based on the indexation for our particular country, for starting at the years that we've indicated. Then we also check, are there any carbon allowance benefits? Are there any other market-wide benefits that can be counted against our OPEX? Do we receive any ongoing market-wide subsidy, for example, like the SDE plus, and then the OPEX is reduced by this. Next slide, please. So the example here, very simply, here we have a capacity input, we have a reference product price input. We assume that there's no premium of our product to the price in the market, so we're not producing something that has a market standard better price. So an example might be, let's say, some sort of a bioproduct, which even though it's sold on the market, it's generally accepted that because of its provenance, it receives a higher price. There's no premium here. We're just assuming that that is the same as the reference product price. We have a data financial close so that we can determine what the construction period is and when our operations start from a revenue point of view. We have a construction cost that we input. And then importantly, we determine what the project lifetime is. And the project lifetime has to accord with what is generally accepted in the market for this sort of project. And in an industrial project, it's usually related to the standard accounting treatment of the depreciation of the assets or the useful asset lifetime. Here we have a production ramp up as well. Does the production take a while to ramp up over a certain amount of years, or in year one is all of 100% of the production produced? And in this case, we're saying yes, it is. Here, our indexation, as an example, is 2% based on inflation rates that we have in the market. Next slide, please. And here we look at, do we receive any operational benefits, any public support or any other benefits? Here, the only benefit is the amount of carbon allowances sold. Here we have a figure in, it's not the correct figure for the carbon price as it stands today, but just for purposes of example, we've put in 25 there. Then we input the operational operating costs, O&M and other variable costs over time, and that is at today's price. Then those in the calculation are escalated according to the indexation. Then we have a feedstock price, again, a variable cost, and we come to a total. We might have some fixed overheads associated with that, and that's fixed per year. And then we have operating costs in total based on the model forecast, which will give us an amount per year. The other thing that we look is, are there occasional life cycle costs? So, for example, does equipment need to be replaced does equipment run out after a certain amount of hours of operation? We have to include that as a life cycle cost amount, so included, as it were, a piece of capex coming in at a later stage. Next slide, please. So the first thing is how many units are forecast to be produced. We input that into the model over the lifetime of the model. We then use the weighted average cost of capital, and we calculate the weighted average cost of capital by calculating the cost of equity. And in industrial projects, that's done either through the the capital asset pricing model, done based on what the cost of equity is in the market for that type of industry. We look at the cost of debt, which is the actual cost of debt. So that would be your base rate plus the margin you expect to get from the bank. And then you get a blended or weighted average cost of capital. Here, in this case, it's 7.33%. We then discount the OPEX and the units produced over the project lifetime using the WACC, our blended cost of capital, or weighted average cost of capital, and then divide the CAPEX plus the present value of the OPEX by the total discounted units produced for what is a levelized cost. In other words, a flat, non-escalating cost of production per unit over the lifetime of the project. Next slide. Then we establish the difference between the reference price, which is a price, not a unitized cost, important to remember that, and we get a difference. Now, the expectation obviously is that the unitized cost of production is going to be more expensive than the reference price. And then we establish the difference between these. Once that difference has been established, we times that by the discounted production over the lifetime of the project, and we then calculate what the levelized cost minus the reference cost is for the full set of production, discounted production units over the lifetime of the project. Next slide. Of course, then we have to make that small adjustment for the OPEX over the 10 years. So that difference then is multiplied, is multiplied by 1 minus the percentage, which is represented by the OPEX after 10 years. So here, after all those calculations, we then come up with a relevant cost, which is 10.8 million euros. We, of course, don't take account of the full relevant cost. We take account of what the eligible amount is, which is 60% of that, and therefore the maximum Innovation Fund grant in this case would be 6.5 million euros approximately. Now, important to note that that is the maximum. So the whole purpose of this calculation is not to calculate the actual amount that you will bid in at, it's just to calculate what is the maximum amount that you would, in theory, be able to apply for. And I'll get to that right at the end of the presentation and just emphasize that point. Next slide, please. So levelized cost of storage, this is a very similar methodology to the other two with a slight difference in that electricity storage revenues differ from country to country. And in certain countries, you do have certain revenue streams, and other countries you don't. Now, those revenue streams will depend on how your unit is set up, what particular market prices and services it can bid into. And therefore, there's no standardized market price for electricity storage. It's done on a country by country and what we call a use case by use case calculation. So this works in exactly the same way as the other methodologies work, except it defines a specific use case for the project. So for the project then defines what is it in fact bidding into as far as the services are concerned. What are those services priced at historically? And then it creates an artificial market price by taking those services, the revenues for those services in a year, divided by the amount of megawatt hours discharged, and gets a comparable market price to what would be a levelized cost of storage price. And the levelized cost of storage then is calculated very similarly to the other methodologies, in that it is simply a calculation of a unit cost over the lifetime of the project using the weighted average cost of capital as the discounting factor. So you have a market price or a reference price, which is a price as at today, which will escalate over time, and you compare that against your calculation for levelized cost of storage, which is the capex minus the O&M and the cost of charging, which is your other OPEX cost, over the discounted amount of electricity over the lifetime discharged. Next slide, please. So now we've dealt with the methodologies very briefly. I think most of you are, in fact, familiar with these methodologies, so it was just a refresher. But there is a new component which you wouldn't have seen yet, which is really just to enforce some discipline and commonality across projects to make it, one, easier for reviewers to be able to make sure that they, one, have enough information to evaluate the project, and that the evaluation is done on a consistent basis. But it also forces applicants to make sure that they have a standardized and sufficient set of information that can be evaluated. So now there's a requirement to produce what's called a financial model summary sheet. And this is a summary sheet which standardizes the information into a standard set of entries into a template, an Excel template, which is available for download from the Funding and Tenders portal. And these are amounts which will come from your standard financial model, which will be cut and pasted into the standardized template, and then will be evaluated on a common basis across all projects. And this does two things. It allows the evaluation to be common. In other words, the same set of evaluation procedures will be done across projects. But the other thing it does is act as a very good checking mechanism, just to make sure that the type of information that's expected in the application is actually adhered to. Next slide. So the financial model summary sheet has a number of standard project finance type inputs. It's got the project timing, when the project starts, when it's operational, and when it ends. It has the funding sources, where's the funding coming from, equity, the loans, both senior, junior debt, if that's relevant. It also provides a profit and loss and a set of standardized financial accounts. And this also just checks that things balance in the financial model that has been provided to us. Next slide. So, of course, cash flow statement as well, and balance sheet. Again, I talked about balancing items, but those are relatively standardized and laid out in a standard format. It's done on a yearly basis. So if your project is a semi-annual project, or your project finance model is doing it on a monthly or quarterly basis, the yearly figures that come out of your financial model will be input into this model. Next slide. So as far as the approaches for applicants, it's very important, as you would normally do in any financial model, that you have a set of inputs which are the only cells which can be changed. You have calculation cells and reference cells, and these should not be changed in the model. So everything which is in yellow, the yellow cells are for inputs by the project applicant, and everything else should be left alone, because those are calculated sheets. And any changes that are made in the non-yellow cells will compromise the integrity of the information submitted to us. Next slide. So again, just to go over the process, all the expected funding uses and sources must be inputted. These are both construction and operation. These funding sources should correspond to the total financing package expected to be secured at financial close. So once the project is financed and closed, all funding sources must be included there. And the amount of innovation fund grant that's expected to be disbursed during construction and projected, in other words, that the application is making an application for, should be in line with the project milestones and should be inputted into this model. And this model will then calculate a pre and a post-innovation grant IRR, and this allows for easier evaluation by the expert evaluators. And any grant, this is an important point, any grant that's disbursed prior to construction should be recorded as a reduction in the development cost component of the CapEx in the model. So when inputting this amount of the Innovation Fund grant, you'll see that there is a space to do that in the model. Next slide. Okay. The next thing is to note that the relevant cost calculation is a very simplified calculation when compared to a standard project model, which will be relatively complex, have a whole lot of different inputs, and have a lot of lines of financial information. The relevant cost calculation is a simplified version of this, but it's very important that the financial model spreadsheet must be consistent. So the inputs that are being put into the relevant cost calculation must be directly related to that information that's inputted into the financial model spreadsheet. And the financial model spreadsheet is the minimum required information. So those must be consistent. You are able to submit a full project financial model alongside the financial model spreadsheet. It's not a requirement, but it might help with the evaluation. If you feel that is the case, you can submit that alongside it. But everything we're provided must follow good practice and be easy to read and reference. It can't be a very complex financial model where inputs and assumptions and calculations are mixed up, where there are lots of references which are difficult to follow. If a project financial model, in addition, is provided, it must be well set out, it must follow good practice, and it must be easy to navigate. So links, of course, between the relevant cost inputs and calculations and the financial model inputs should be marked. And important to note, if you feel that this is too much information, the financial model spreadsheet, or you don't have information, that would probably be an indication of lack of financial maturity. Any project which is asking for a very large amount of money from a concessional funder should have extremely detailed, well elaborated and checked and verified financial information. So please make sure that is the case. If you feel you can submit an application with incomplete financial information, this is obviously compromise your application. You can download the fully developed financial model example as well. There's an example which relates to an energy funding project on a accepted, standardized, open source style financial model spreadsheet. You can look at this, download it as an example of what a project financial model might look like. Next slide, please. Also on the financial model spreadsheet summary sheet, you will see a profit and loss, a balance sheet, cash flow, and IRR analysis, which will come out of that. You can refer to that. If there are any errors in that sheet, you obviously can refer back to where an input hasn't been provided or something has been changed which shouldn't have. Next slide, thank you. Okay, so this is the last slide of the presentation, and this is an important slide in that everything that I've been discussing thus far is to be able to provide evidence of financial maturity and to be able to calculate correctly the relevant cost calculation. And the relevant cost calculation will result, once times by 60%, in what the ceiling is that you can apply for in the Innovation Fund process. But that ceiling is not exactly what you will end up applying for. It might well be, in order to be more cost effective, or be cost competitive, that you will want to reduce the amount to the absolutely necessary amount that gives you a sufficient commercial return for the project to actually happen. And remember, this is a competitive process, and the cost efficiency criterion is evaluated by the relevant costs, or the relevant costs applied for, the applicant's costs applied for, divided by the amount of emission avoidance, so the tons of carbon dioxide avoided. So that calculation will mean that a project which applies absolutely at the ceiling will be less competitive than a project that applies at a lower amount. And this is up to each applicant to decide, but it's important to note that all of these calculations are only to determine what is the ceiling amount, what's the maximum amount that could be applied for. It's not necessarily going to be the amount that is in fact applied for. So thank you very much for your time. We welcome questions. And apologies that for some reason the application didn't allow me to put my camera on. I wasn't able to do that during the presentation. I'm not sure if you were able to see me. I couldn't see myself. But I am here, and thank you very much. That's the end of my presentation.
Yes, thank you very much, Gregor. Indeed, we weren't able to see you, but fortunately, we were able to hear you loud and clear, and this is very important. Thanks to you and Roman for the very detailed presentation. I'm sure I'm not the only one who would like to watch that again, pressing pause and thinking carefully of different aspects. I see we have a lot of questions on Slido, over 550 people watching us. The questions are many. We won't be able to answer all of them now, but what I will try to do is just group them in wider constellations and topics, and we try to provide answers that cover as wider ground as possible. If we don't manage to answer your question today, please don't hesitate to submit it via the Innovation Fund Help Desk, where you'll get a written reply in the usual timeframes. And of course, don't hesitate to watch again the video and the presentations. They'll be made online, available a few days after the event. So if I start with the first group of questions, I would maybe group it around various uncertainties that you flag. So what happens if funding is cancelled before the financial close? And also there is a question which has attracted a lot of likes, stating that contracts cannot be final before grant support is approved. And will letter of intents and memoranda of understanding and high-level estimations be sufficient for the application? Roman, anything we would like to say on that?
Yeah. So for these uncertainties, please take into account that the Innovation Fund will disburse grants upon reaching project milestones. Okay, even though the 40% that we can pay before or after financial close is not related to achieved greenhouse gas emissions, you will always need to reach certain milestones in order to receive those grants. There is obviously a risk that we are taking in case the project is cancelled before reaching financial close. However, you will only be able to receive grants if you meet your particular milestones that can be there before the financial close, such as concluding the FEED study or concluding the drilling in terms of, in case of a geothermal project. When it comes to the contracts that cannot be final before grant, yes, this is true. But since we are already in the second stage, you should have a very clear and precise indications from your suppliers, from your off-takers, what would be, let's say, the framework contract conditions, so that you can essentially plot the estimates, whether this relates to costs or revenues, into your projections, into your financial modeling. So the more precise you are on those, even though these are still framework conditions, the better. So don't expect that evaluators would be giving high scores if you will not be at least showing what is the framework on these contracts, what are the expectations for our suppliers or off-takers, with many caveats, of course, because these contracts can be finalized only later on.
Thank you, Roman. Another group of questions which I see is quite popular is around the due diligence report. In general, documents submitted in the first phase. So, about the due diligence reports, can we clarify, are they compulsory? Can previously submitted ones be updated, etc.?
So the due diligence reports are not compulsory. This is at your decision whether you want to submit them or not. If you have them, you are invited to do so. And yes, they can be updated, as you can update your business plan, as you can update your implementation plan, or your feasibility study.
Yes, thank you very much. Which then brings me to a bit of group of practicalities of questions. So there are questions: how will the page limit impact the need for more detailed risk assessment? Should supporting documents follow the indicative content in Part B, etc.? So anything we would like to comment on this?
Yes, we have provided a bigger page limit for the second stage. So this has been increased, and you can see this already in the section 8 of the application form. This allows you to provide more information, more profound information in the documentation. So this is already provided, and please be focused on key information. Okay, this is the second stage, so really focus on the information that matters and that builds your story and make it more credible.
Yes, thank you. And then probably the last group of questions, which is quite heterogeneous but very important. It has to deal with various prices and indicators which should be used in the calculations. I see that the most voted question is about the CO2 price, and there are several along these lines. So what about the CO2 price changing over the lifetime of the project? How should we deal with projects using different CO2 prices? So this is one group. Then a second group concerns the reference price. Should it be the production or the sales price? A third indicator is about the cost of reference product increasing over the lifetime of the project, so still a change of an indicator. There is also a question if we can provide an example of an OPEX adjustment. And last but not least, there is a quite concrete question: should the WACC be company-specific, project-specific, general, or what about the WACC? So quite a few indicators, but maybe you or Gregor can quickly answer these ones.
Gregor, can you address those?
Yeah, you might have to remind me of some of the some of the questions. So yeah, as far as the calculations are concerned, a price as set out in the presentation regarding carbon should be included as per the guidelines 2019-2020. I think it was 21.84 that deals with that question. As far as escalation of prices is concerned, again, falling back on the specific inflation and indexation figures which are relevant to your own country. Again, focus on table 4.2 in the guidance document. There was you'll have to remind me, the WACC was the other question, yeah. As far as which WACC do you use, the WACC should be, depending on the type of project, there are benchmark WACCs for your specific country and for your specific technology, if it's related to renewable type, electricity type generation project. And those, again, are referenced and included in the annex. As far as the WACC for industrial projects is concerned, you have the ability either to use a market-wide or company-specific WACC that must be justified, and that will form part of the justification when an expert model audit is provided. That calculation must be correct. It'll be done based on the capital asset pricing model for the equity calculation. the debt must be the actual debt cost of the project. And because the projects are innovation projects, the equity calculation for the cost of equity has an innovation premium associated with that. And that is either a figure which is determined based on the reference to innovation premiums for smaller company projects, and there is a reference as to where to find that sort of information in the annex. As far as the renewable type electricity projects are concerned, those specific technologies are referenced. So you'll find that in the annex as well. There was one other question, I forget which that was. Perhaps you can remind me, Melina.
Yes, if we can say a little bit more about the change of different indicators and an example of updating the OPEX.
Yes, okay. So I think the question related to the OPEX adjustment. So how does that actually work? So in your calculation of relevant costs, you'll have a figure which would be CapEx. You'll have a figure for OPEX. And using that over the lifetime of your project, you'll divide that by the discounted number of units produced. And that will give you a cost for your unitized or levelized unit cost. So that's your that is what you're going to compare against your reference price. Once you've done that and you have the difference between the reference price and the levelized unit cost, that difference then is adjusted. And the adjustment is based on looking at your levelized cost calculation and taking the amount associated with the discounted OPEX for years past year 10. So let's say in a 20-year project, 11 to 20. And let's say that is only 3% of the total levelized cost. Then that difference is adjusted by that 3%. So you times your difference by 97%, and that's the final amount that you use. In some cases, it'll be a little bit bigger. That will represent a bigger amount depending on the extent to which your project is exposed to a high level of OPEX. So in things where you have a fuel component, that's usually the case. Or in the case where OPEX represents a bigger component, and the CapEx is relatively low. In most cases, that's not going to be true. The other thing that will affect it is your actual cost of capital. So if if you have a very high cost of capital, that amount is discounted more towards the end of the project, so it'll be a smaller amount. So so that's basically how it would be done. It's a relatively simple calculation, and in most cases, as I said, it's not going to have a material effect on the actual amount.
Great, thank you very much. One question which has attracted a lot of likes, and it is repeated in various forms throughout, is about the criteria for financial audit. Who is allowed to perform this, and are there accountancy and ISO norms to conform to? Roman, would you like to address this?
Yes. Yes, there is a requirement for the audit statement on the relevant costs calculation. This must be done by the external independent auditor who should audit the correctness of the calculation. And this also includes the confirmation that the inputs to the relevant costs calculation sheets are consistent with the information contained in your financial model summary sheet. And these inputs need to be valid and confirmed by the auditor. The auditor statement must therefore confirm that the relevant costs have been calculated in line with the relevant cost methodology, and that the calculation is correct. This is confirming the integrity of the calculation. The audit statement on the correctness of the calculation should be provided by authorized auditors, so they need to be affiliated to professional audit organizations. And these can be the auditors that already audit the company financials, provided they are external, provided they are independent and affiliated with the professional organizations.
Thank you very much, Roman. We do have a lot of questions, but being mindful also on time and the fact that there are several detailed presentations following, I would suggest we move to the next section. If you feel that your question was not answered or you would like to receive more details, please don't hesitate to submit it also in a more detailed way to the help desk via the CINEA website.